Hello everyone, this is Dr. Aarti Mudliar from the Department of Commerce, the Bhopal School of Social Sciences. And today I am here to teach you the rules of debit and credit under modern approach. In my previous video, you all have watched the traditional approach or the classical approach of applying the rules of debit and credit. But today we are going to discuss about how under modern approach the accounts can be divided into different categories. Well, dear students, under the modern approach, or also known as an accounting equation approach. Now, as we all know, under accounting equation, we have in the two sides of the equation the assets which are equal to the liabilities and owner's equity. Owner's equity also known as capital. Now, owner's equity gets expanded or deducted because of the revenues or the expenses, or you may also say the net result of revenues and expenses are submerged into capital account or the owner's equity. That is why this approach is known as accounting equation approach. Now, all the elements of this accounting equation can be disclosed as this: assets is equal to liabilities plus capital, whereas we can further expand it as liabilities plus capital, where capital can be increased with the revenues, that is, the revenues are added to the capital and can be deducted or decreased because of the expenses, that is, all the expenses are deducted from the capital. Hence, the net result is known as owner's equity. Now, to understand this approach well, we divide all the accounts into 5 categories, right? The first category being asset, the second category being liabilities, the third category being owner's equity or the capital, the fourth one being revenue, and the fifth one being expenses. This is the easiest approach to understand and very easy to apply as well. Now, let us understand about each of these accounts separately one by one. The first one being asset account. Now, under asset account, we consider all the property of a business enterprise. Now, the properties can be the fixed assets or the current assets. The fixed assets being land and building, furniture, plant and machinery. It can be intangible fixed assets as well, like patents, copyrights, as we had discussed earlier in the previous video. Coming to the second category, that is liabilities. Now, under liabilities, it is nothing but the financial obligation towards the external parties, that is, how the business owes to the outsiders. All that amount, for example, like bank loan, like outstanding expenses, creditors, that is, our suppliers from whom we purchase the goods on credit. So, all these parties are external parties, and the parties to whom the business owes some financial amount are known as liabilities. Now, the third part being capital. Now, capital is nothing but the financial obligation towards the owner. That is, the owner, when he invests some amount in the firm or in any enterprise, then the enterprise, being a separate entity, becomes obliged to the owner. That is why in a business enterprise, owner's equity is recorded as capital. Next, we come to the revenue. Now, under this category, we record all the benefits that are received by the enterprise. Now, these benefits can be in the nature of operating, or it can be in the nature of non-operating. Now, the operating revenues that are received by a business enterprise are nothing but through sales. Sale of services or sale of goods, both are recorded under revenue category itself as sales revenue or revenue from operations. Other than that, also business can earn various revenues like interest received, discount received, commission received, rent received. So, these are all the other than operational revenues which a business enterprise can earn, but together all these revenues are categorized under this particular head. All the incomes will be categorized under the head revenue. That is, by rendering services or by selling goods, a business can earn revenue. Further, we move to expenses account. Now, under the expense account, if we purchase any benefit from the outsiders and pay for it, then such amount is recorded as expenses. The very first expenses or the operational expense is the purchase account, right? Now, purchase account is nothing but the expense incurred for purchasing the goods that is meant for resale. There can be further expenses like wages or the manufacturing expenses incurred or freight, carriage. All these expenses are incurred for the operations of business. For the maintenance of office and administration also, there can be various expenses that are incurred, which can be salary, office rent, postage and telegraph, printing and stationery expenses, advertisement expenses, salesman's commission. So there are n number of expenses that can be incurred at the time of purchasing the goods, manufacturing the goods, within the factory, or in the office and administration, as well as for selling and distribution. All these expenses are recorded and as expense account. There can be some non-operating expenses as well. For example, interest paid on loan, or maybe some losses that are incurred at the time of sale of fixed assets also. So remember to categorize all these account names under the category of expenses. Now, all of you must have understood that how the 5 category of accounts are to be understood and which all items are to be categorized under these particular heads. Now, how to apply the rule for debit and credit under modern approach? First thing is to identify that in a particular financial transaction, how many accounts are getting affected. So, in a particular financial transaction, at least 2 accounts will be affected, or more than 2 accounts may also get affected. So, the first thing is we need to identify the names of the accounts. Then we need to identify that under which category these account names are falling. So, all these account names will be falling either in any of the 5 major heads, that is asset account, liabilities account, capital account, revenues account, or expenses account. Once you have identified that the account name that has been affected in a particular transaction belongs to a certain category, then we will apply the rule. Now, to understand the rule, let us go ahead. That is, we need to observe the increase or decrease in these particular category in that particular transaction. So, in that transaction, either the asset or the liability or capital or revenue or expense will be either increasing or decreasing. So, once we have identified that whether these are increasing or decreasing, then we go ahead with the rule. So, the rule is increase in assets and expenses are debited, whereas decrease in expenses and assets are credited, right? Whereas when we talk about the other 3 categories of accounts, that is liabilities, capital and revenue, increase in liability, capital and revenues are credited, whereas the decrease in the liability, capital and revenues are debited. So, this flow chart is telling you the increase or decrease in the assets and expenses, how they are debited, and increase and decrease in the liability, capital and revenue, so when they are debited and when they are credited. I'll tell you an easy way of understanding the rule, that is through this grid. So, as you can see, all the 5 accounts have been listed over here, that is asset, liability, capital, revenue and expenses. The increase is the first row where you can see the extreme 2 ends, that is asset and expenses. When they increase, they are debited, and the middle ones, that is liability, capital and revenues, are credited when they are increased. Just the opposite of is at the bottom, that is decrease of these accounts. So, when the assets and expense, the extreme 2 ends are decreasing, that is when the asset is decreasing in the business or the expenses are decreasing in the business, you need to credit that particular account. And same goes with the middle ones, that is liability, capital and revenue. When you find a decrease in the liability or a decrease in the capital or decrease in revenue, it has to be debited. So, now comes the practice time. Let us take some examples and try to fit into our grid so that we can understand the steps involved in analyzing a particular transaction. So, here is the transaction analysis. The first transaction being purchased furniture from X company. Now, first thing is to identify the number of accounts getting affected in a particular transaction. So, in this particular transaction, as you have observed, that we are purchasing it from a particular company, and nowhere in this transaction it has been mentioned that it has been purchased in cash. right? How did we identify this? Because a party's name has been mentioned in this particular transaction, which shows or which implies that this furniture has been purchased on credit from this party. That is why we have still recorded its name. Now, if a party's name has been recorded, that means it is a vendor who has given us good on credit. Therefore, we owe that particular party. Though that party's name has to be recorded as a vendor, as a creditor, right? And since we owe that party, therefore it is a liability. So the first thing is we have identified two accounts. One is furniture account and other one X Company Limited, right? These are the two names of the accounts. Then the second thing is we need to categorize them as type of account. So which type of account is furniture? Furniture is the property of business, hence it is an asset. Whereas X company is a party to whom the enterprise owes, therefore it is a liability. Now both the asset and liabilities, we need to observe whether they are increasing or decreasing. Since we have purchased the furniture or the property of the business is increasing, therefore we observe the increase in asset. Whereas in the case of liability, then again we observe that since the liability is increasing as we are purchasing the property on credit basis, therefore liability also has increased. Now we have observed that both the accounts have increased. So let us recall the rule. Increase in assets are debited, hence furniture account will be debited, and increase in liabilities are credited, therefore vendor's account will be credited. Since the name of vendor is provided to us in this transaction itself, so we will credit X Limited account. Therefore, the journal entry for this shall be furniture account debited to X Company Limited. Now, when we are passing journal entry, we need to remember that we need to follow a certain format. Now, why the formats are necessary? Because it leads to better understanding and better presentation and uniformity in the presentation of accounting affairs of an enterprise. Now, this format is followed by all the enterprises similarly. That is why the first column is for date. Now, date is to maintain the chronology, right? All the transactions are recorded in a journal book which is known as day book or a rough book or subsidiary books. Now, first thing is all the recording is done as and when it is occurred, that is in a chronology. That is why date column is most important. So, first thing you need to write down the date of the transaction in which it has occurred. The second column being particulars where we given the details of the transaction. So, the account that is debited is written to the left alignment, whereas the account which has been credited is to be written in the right alignment. And we use a prefix that is to along with the account that is being credited. Now, ledger folio, the third column, that is represents the page number or the folio number to which this transaction shall be classified and posted to a particular ledger account. So, we need to mention that where this particular transaction leads to, right? Next column are the amount columns, which are divided in two parts, the debit amounts and the credit amounts. So, in this transaction, the account which has been debited is written on the top, and in that row itself, we need to write in the amount column its respective amount. Whereas the account which has been credited, which is written below the debit amount, the same amount, the corresponding amount has to be written in the credit column just in the same row in front of the credit account. So, therefore, it looks like furniture account to X Company Limited, and the respective amounts have been written neatly in their respective amount columns. Let's look at the next example. Now, here a slight change has been observed, that is, the furniture has been purchased for cash. It is written clearly that it has been purchased on cash. So, we do not record the party's name because we have already paid the party the amount required. Now, again in this transaction, two accounts are getting affected. One is furniture that we have received, and another account is the cash account, that is the cash that we have paid to the supplier. Now, the two accounts affected is furniture and cash, and both belongs to asset category only. So, the rule for asset account shall apply, but before applying the rule, we need to observe whether they have increased or decreased. So as per observation, we can clearly see that the furniture has been increased because we have purchased it, and the cash is decreasing because we are paying cash to the supplier. Therefore, increase in assets are debited and decrease in assets are credited. Thus, in the journal entry, we need to write furniture account debited to cash, that is, increase in the asset is debited, furniture is debited, and decrease in asset is credited, therefore cash will be credited. You need to follow the same presentation or the same recording pattern as we have just now learned, that is, the corresponding debit amount shall be written in the debit row and the amount of credit shall be written corresponding to the credit row. The next example is if we are purchasing goods. See, furniture in the previous two examples were asset, fixed asset. If we are purchasing goods from any supplier, in that case we need not use goods account, right? Instead, we use a specific name, that is purchases account, because whatever amount we are spending to purchase the goods that are meant for sale represents the expenses. That is why instead of using goods account, we use the name purchases account, which is expense in nature. The other account name is Y company, who are the suppliers. So we owe them because we need to pay them later on. Now in this transaction also nowhere the word cash has been mentioned. That's why we'll assume it as these goods have been purchased on credit basis. So there are two accounts that has been identified. Number one, purchase account, and number two, creditors account. Who are the creditors? Y company. If creditor's name is given to you in the transaction, you will use the name. Otherwise, we may use supplier's account or creditor's account as well. Now, once the two accounts have been identified, the next thing is identify to which category or which type they belong to. So purchases is expense account and Y company is liabilities account. Now we need to observe whether they are increasing or decreasing. So when you are purchasing, that means expenses are increasing. And when you have not paid yet, your liabilities are also increasing. So both the accounts have been observed as increasing. Now apply the rule. Increase in expenses are also debited as in asset. Increase in expenses are debited, whereas increase in liabilities are credited. Thus, the journal entry shall be purchases account debited to Y company, that is the creditors. Now suppose if just this transaction says purchased goods, nothing else has been mentioned, neither the party's name is mentioned nor cash account has been mentioned whether the goods have been purchased on cash or not. In that case, we will assume that the goods have been purchased on cash basis only. That is, you need to identify in a particular transaction if any party's name is given, that means you can assume it. It implies that the goods have been purchased on credit basis. If party's name has not been mentioned, then we will take it as a cash purchase. Now in this case, purchase account and cash account, these two accounts getting affected, one being expense and cash account being asset. Now the rule says that increase in expenses are debited and decrease in assets are credited. Therefore, the simple journal entry will be purchases account debited to cash. Okay, we have till now talked about certain transactions that leads to either asset account, liabilities account or expenses account. Now let's talk about something else. That is, what if we are selling the goods? So let us write the transaction goods sold. Goods sold. Now in this case, we need to identify the name of the account. See, when the goods are sold, again we need not use the name goods account. Instead, we use the name sales account. So I am writing here sales account. Now what do you mean by sales account? Sales account is nothing but a revenue account, right? The revenue that we are receiving by selling the goods. What is the other account getting affected? Well, if nothing has been mentioned that to whom the goods have been sold or the party's name is not given, then we cannot assume it as a credit sales. Therefore, it will be assumed as a cash sales. Therefore, we will write cash account, that is the other account getting affected. Now, cash account again is a asset account. So, the type of account is asset, whereas sales account is a revenue account, right? Now, apply the rule. whether the asset are increasing. Yes, we are receiving cash and the cash is increasing, asset is increasing. Therefore, we observe that the cash has increased, whereas sales account, the revenue also has increased. Okay. So, this is called transaction analysis. We are analyzing a particular transaction stepwise. Now, we will apply the rule. Increase in assets are debited, whereas increase in revenues are credited. Therefore, which account will be debited? Cash account will be debited and sales account will be credited. So, let us write the journal entry. First, if the dates are given, we will write the date. Otherwise, we will simply write cash account debited to sales account. And if the amounts are given to you, then record the amount, the debit amount in the debit side and the credit amount in the credit side. Hope you have understood the transaction analysis with the modern approach. See you in my next video. Till then, bye-bye.